Garrett, through the summer and early fall, stocks kept hitting new highs, but we've seen some of the froth come off in recent weeks. What's going on right now in the market, according to yourself?
Yeah, well, it's always hard to get a real sense of what's shifting the narrative, but it has been a dramatic pivot. I think it's been a confluence of factors. There's obviously some concern about a hawkish shift with the Fed, but I think the bigger story is you've seen a little bit of a shift in the market's reaction function with respect to AI CapEx spend, and that free pass has kind of been revoked, and you're not seeing the same response in terms of the market reaction to CapEx announcements. And I think that's a concern around a little bit of the circular financing, a little bit in terms of unknown payoff here. And, I think ultimately it's really just cleaning up a little bit of the sentiment, and that helps to actually clear the runway for a renewed push into the year end, in our view.
So how concerned are you? You don't sound that concerned, because I think that the S&P is about a third into the Magnificent Seven stocks or so. That seems awfully concentrated.
Yeah, it is. And, I would say we hear this basically every single year, right? Narrow markets or top heavy markets. I would say there is a distinction between the two. They're not the same. But market breadth has actually been pretty decent this year. It's only recently that we've seen that deteriorate a little bit more markedly. But, I think it's a little bit more narrative driven, right? You have concerns around this K-shaped economy that everyone is talking about. What's really been driving and drawing inflows has been AI. And so it kind of makes sense that investors have been, focusing on, I'd say, chicken beta, right? What's working? But ultimately, that sets you up for some opportunities for maybe getting a little overcrowded, a little bit overcrowded positioning, and a little bit overextended sentiment. And that makes you susceptible to a little bit of a cleanup in terms of some of that froth. And I think that's what we're seeing right now.
I'm going to keep hammering the bear case. What about valuations? I think they were at 23 times forward earnings in the S&P. Doesn't faze you? Once again, this is just a lot of cleaning up things.
Yeah, I think the valuation story is something that we push back on. It's not great, I think, as most people know, as a near-term timing tool. It's more of a utility is in longer-term outlooks here. But I think the bigger story is that if you're looking at prior averages, that misses the fact that valuations are kind of a moving target, right? They're not static, they're dynamic. And I think the bigger story underneath the surface is that the composition of indices has shifted quite dramatically. These are far more profitable, high-margin businesses, and that offers ultimately a little bit more clarity and confidence for investors in terms of the results. And that ultimately requires and demands a higher multiple assigned to it. And I think that means that multiples might be a little bit extended relative to history, but the fundamentals in many ways actually justify that.
So this is a buy the dip situation, or do you let the froth clear off a little bit more?
Yeah, I think it's ultimately hard to pick the bottoms here, but keep it simple, boil it back down to first principles, right? Labor markets are cooling. There are some risks there, but I think ultimately it's cooling, not cracking. In our view, underlying inflation trends remain encouraging, and if anything, are improving. The Fed is, a little bit hawkish maybe in the near term relative to expectations a month or two ago, but that easing bias remains intact. And despite all the fears around AI, I think that CapEx story remains very much alive. And so ultimately, that's a pretty good and constructive backdrop for risk into next year.
And then finally, aside from the Magnificent Seven, where else are you looking in 2026 with regard to the equity market for outperformance?
Yeah, I think it's going to be kind of rolling back the playbook we've used over the last couple of years, which is this kind of growth and cyclical barbell, right? I think we're in a period where growth, economic growth is certainly maybe at or slightly below trend. Maybe the narrative in the near term is a little bit, overly sanguine on the growth backdrop. But ultimately, as I just kind of laid out, I think it's still a pretty decent and constructive backdrop for the economy here to chug along, probably close to trend, maybe a little bit below. And that means a pretty good backdrop for, I think, cyclicals as well, the growth complex to regain leadership.
All right, well, thanks for coming on and talking about it.
Thanks for having me, Greg.